All right, I am super excited to share how real estate investing can change your life. I covered this during our Wealth Club meeting last week, and I had enough people reaching out saying they couldn't make it, that they wanted to be able to attend the class. So I'm doing a quick video here to kind of recap what we went over. This is going to be a shortened version. If you're listening to the audio, be sure to hop on YouTube and check it out so you can see kind of the presentation and a little bit more in depth. But for those of you that aren't aware, we launched Wealth Club inside of our real estate brokerage a few months ago, and it's open to anybody and everybody. It doesn't matter if you're a real estate agent or not, or if you're a real estate agent at another brokerage, you're welcome to attend. So if you're looking to improve your life, whether it be through faith, family, finances, fitness, or friendship, the Wealth Club is a great place to do that. We do meet once a month where we'll cover topics, as this month, as you can see, was Real Estate Investing 101. So I'm excited to dive in. I'm going to share why you should invest in real estate, some terminology that you need to know, how to calculate deals, and ultimately how to find deals. So the question that we started off with is why invest in real estate? And I didn't number it, but I think we have roughly 9 things that we're going to cover as to why you should invest in real estate. Reason number one is cash flow. Rental properties create monthly income. This is reliable passive income stream. So people are going to pay their rent because they have to have a place to live. And it can be passive depending on how you structure it. Do you use a property management company or do you manage it yourself? Obviously, you can get a little bit more of a return, but you're essentially buying yourself a job by managing it. But if done properly, you can make this a passive income stream. And my favorite thing about investing in real estate is access to income right now, not in retirement. So if you invest in an IRA, if you invest in a 401k, you can't access those funds until you're 59 and a half. So I like the fact that I can access the cash immediately, but yet I'm building my net worth over time, which leads into the next one, which is net worth and appreciation. Real estate values historically increase over time, which obviously increases your net worth. If you own a home that you bought for $250,000 and it goes up in value to $350,000, you've earned another $150,000 on your net worth. And as values go up, rents tend to go up as well. That is a historical trend that stick together. It only makes sense. You wouldn't see somebody go out and buy a house that's worth 350,000 and never increase their rent as the home goes up in value. Rents always increase as values do. You build equity as the tenant pays down the mortgage. So if you take out a mortgage on the property every single month, whenever you're making that payment to the bank, a portion of it is paying off your balance and builds equity inside of the house, which again adds to your net worth. And one of the really cool things about real estate is the leverage that you're able to achieve, meaning you're leveraging other people's money. So low down payments. That means you earn an appreciation on the entire house value, not just your down payment. So if you invest $10,000 buying a $300,000 house, and that house goes up in value 4% in the next year, you've gained $12,000 to your net worth on a $10,000 investment. That's a 120% return. You will not find that in the stock market. If you're lucky, you may find 10 or 15%. So if you invest that same $10,000 in the stock market, a year from now, you'll have 11,000, maybe 11,500. Whereas if you buy a house, you can get over 100% return in that particular scenario. There's obviously huge tax advantages as well to owning real estate. Depreciation allows you to deduct part of the property value. And I'll go into depreciation in depth here in just a little bit. So I'm not going to dive into that right now, but there's accelerated depreciation. You can obviously do deductions for property taxes, mortgage, interest, repairs, insurance, anything that it ultimately is an expense against your real estate investing business. And 1031 exchanges allows you to defer capital gains to a later date, as long as you change similar properties. The great thing about investing in real estate is it is a huge hedge against inflation. If you remember in 2022, 2023, people were going to shopping marts, the grocery stores, and they felt like they were getting robbed because everything was inflating so quickly. Well, during that same period, home values were inflating very, very quickly. So buying real estate allows you to hedge your bet on inflation. Real estate typically outpaces inflation over time, which protects your buying power. Another reason why you should invest in real estate is you actually have control over this investment. Whenever you buy into a mutual fund, whenever you buy a single stock of a company, you have no control over what happens. You literally invest the money and you hope that the company does good things, which then gets you a return on your investment. With real estate, you can do things that actually control your investment. You can improve the property. So you can put in some sweat equity into the property and earn some equity through the hard work that you do. You can also improve the property, which would allow you to raise rents, get you a better return on your money. You can reduce expenses on a property, meaning maybe you were paying for the utilities on the property. Maybe you shift those utilities to the actual tenant. And then you obviously can screen and decide who gets to live inside your property as long as you're obviously following Fair Housing Acts appropriately. So you have a lot of control over your real estate investment. Investing in real estate allows for diversification. Real estate adds stability and balance to a portfolio of stocks, bonds, or even crypto. There's less volatility and more predictability over the long term with real estate investing. You can also create generational wealth. So real estate can be passed down, providing both cash flow and appreciation for your heirs. It builds a family legacy of financial independence. I know a lot of families that didn't have a lot of money and they had somebody in the family that owned real estate and passed that down and it changed their life. So this is an opportunity that you have to leave for your heirs. Um, One of the really great things about real estate is it's actually a tangible asset. It's not like a stock where you invest it and you just see your dollars on your screen. It is something you can go see, you can touch it, you can prove it, you can live in it, you can rent it. So this creates a peace of mind for a lot of people. My mom is very risk adverse, so they didn't want to invest in the stock market. They were worried about it, so they wanted to do I'm blanking out, but they wanted to basically invest it at the bank. And I said, you're not getting a strong enough return. And she said, I want something that is steady and safe. So actually buying a house is that. You can physically see the house. If things go bad, you can sell the house. So it is a tangible asset that you can physically touch and see. So I want to run through a quick example right now. So do me a favor, pull out your cell phone and go to your app store if you don't already have it and type in Place Mortgage Calculator. And it should have a black backdrop with white letters that says Place Mortgage Calculator. If you don't already have it, I highly suggest you download this because it'll help you run analysis to figure out what your mortgage payment will be on properties. If you're a real estate agent, it has a very valuable tool where you click on Calculator, and we're actually going to run through this tool right now, but click on once you have it downloaded, pause this if you need to, download it. And once you have it downloaded, click on the calculator button at the very bottom of the screen. And I'm literally doing this scenario right now on my phone. And then click the second button down, which says the value of homeownership, and click calculate value. And then hit the get started button. And then we're going to input what you see on the screen. If you're watching this on YouTube, you can see we're going to do a quick scenario. You're buying a house for $250,000. And we're going to assume you're going to own or occupy this, which allows you to put less money down. So we're going to put 5% down. Then we're going to assume we're doing a 30-year mortgage and an interest rate of 7%. Here in the Midwest, appreciation's pretty steady, typically around the 2 to 5% mark. So we're going to put in 4% annual appreciation. After that, you can put down your specific scenario, but for my example, I just put down that I am married since I am married, and then I added just left the annual income as it came up, which was between 80,000 and 171,000. Once you put all that information in, hit view results, and we'll go through what it looks like. So in your first year, if you buy a $250,000 house, the home is going to go up in value $10,000 at a 4% at a 4% appreciation. We've seen that skew throughout time. Some years it goes up 2%, some years it goes up a lot. A few years ago, it went up 13%. So in this scenario, we said 4%, so you're gaining $10,000 in appreciation. Next, we're going to look at equity. You hit the next button and it'll show you $2,413 is how much you've paid down the balance of your loan. And then next, there's tax savings because you get to write off your property taxes. You get a write off interest payments, and you can see there's $3,641 gained through tax savings. So that is a $16,053 increase to your net worth in your first year. And here's the cool part about it. You put down 5% on a $250,000 property. So that was $12,500 that you put down. And in your first year, you gained $16,000 to your net worth. So that's a 133% return. That's what I'm talking about by leverage. You are getting the benefits of owning a $250,000 house while only putting $10,000 down. And that is just year one. And this is assuming that you're living in the house, not that you are a real estate investor, because if you're a real estate investor, you can also depreciate the property as well. Before I dive into depreciation, I want to do a quick example here. Let's say you were to go out and buy a house this year and you want to be able to buy a home with low to no money down. So that means you're gonna have to own or occupy it. You could get in a house depending on what the lender's programs are with as little as no money down, or you could do an FHA financing, do 3.5% down, or you could do a mix of somewhere in between. In this scenario, you can see that you purchased the first house in year one for $250,000, put down $8,750. And what happens to that home over the course of 30 years? Now, my goal would be you buy a house, live in it 2 years, go buy another house, live in it for 2 years, go buy another house, live in it for 2 years. And you can do this throughout 5 years. You'll own 5 houses, 5 homes. And then at the end of 30 years, what's it going to look like? So here we are in 2025. Year one, you buy it for $250,000, put $8,750 down at a 7% interest rate. That means a year from today, your property would be worth $260,000, and you're not gaining any rent because you're not renting it out for those first 2 years. But 30 years from now, that property that you paid $250,000 for is going to be worth $828,000. You've also been collecting rents for the last 28 years, which equated to $249,921. So that first home is worth $1,078 to you. But you're repeating this process. So if you do this, you buy 5 homes over the course of 10 years, you can see that at the end of it, between the value of the properties and the rents that you've collected, that is $5.5 million. And your down payments was $8,750, $14,000. So you're at roughly $23,000. Add another $16,500 to that, you're at $39,500. Another $19,000 to that, you're at $58,500, and roughly another $22,000 to that. That gets you to $70,000 of how much money you've put into this, and then paid your payments for the houses that you've lived in, and that is worth $5.5 million in 30 years. So you don't have to overthink it. You could just buy a house, live in it, and then go buy another house, live in it, and go buy another house and live in it. This isn't you going out and making boatloads of money and putting 20 to 30% down on properties. Now, as I mentioned, I want to talk a little bit more about depreciation. I skimmed over that very quickly earlier, but what is depreciation? Depreciation is a non-cash deduction for property such as wear and tear. It only applies to the building, not the land. Typically, the land is worth roughly 20% of the value of the property. And in residential real estate, you can depreciate it over 27 and a half years. Commercial real estate's different. I believe, not off the top of my head, I think that depreciates over 39 years. So what you do is as you can see in the example, if you buy a $250,000 home, roughly 20% is going to be land value. So that's $50,000. You deduct that. That leaves you with $200,000 that they're saying the house is worth, not including the land. You take that $200,000 and divide it by 27 and a half years, and that allows you to take a $7,273 depreciation every single year, even though it's not a true expense. It's just the wear of the property. So what does that actually look like for you? So if you go out and buy a $250,000 property at $200,000, as I mentioned, it's $7,272 per year in a depreciation. Now, let's say you rent that property out for $2,000 a month. That creates $24,000 of income. You have $6,000 of expenses. This could vary. I put an example in, but your expenses are going to be such things as when a tenant moves out, you're going to be maintaining utilities. You're going to have insurance. You're going to have property taxes. So if you have a long-term tenant that stays in the property year after year, your expenses are going to be lower. If you have high turnover, your expenses are going to be higher. But I put $6,000 in there. And then the depreciation, which we just talked about, was $7,272. So in the eyes of the IRS, you will pay taxes on $10,728. However, your true income was $18,000. So you're not having to pay taxes on that depreciation. So big financial upside to depreciation. And I'll go a little bit deeper into accelerated depreciation here in just a second. One thing I want to emphasize that I forgot to clarify right out of the gate. I think you all know this, but I want to clarify I am not an attorney and I am not a CPA. So I am giving you advice as a real estate professional. If you need exact numbers into what the tax situation and depreciation would look like for you, I would highly suggest you talk to your accountant. And again, I'm not giving legal advice. So here's the really cool thing. I know a lot of people, like in our wealth club, it's our real estate brokerage. So everybody at our real estate brokerage has their real estate license or is working full time in real estate. And if you're a real estate professional, you have some additional tax advantages. So as a casual investor, they get depreciation on the property, they get in deductions for expenses, and they can take advantages of 1031 exchanges. And if they have passive losses, meaning losses through depreciation, that can only offset their passive income, such as their real estate investing income. As real estate professionals, and to be a real estate professional, you must work 750 hours per year in real estate, and at least 50% of your working time must be spent in real estate. So, for example, if you're a physician that invests in real estate, you're probably not working 40 hours a week as a physician and then going out and working over 40 hours a week as a real estate investor. So, therefore, you wouldn't qualify as a real estate professional. Now, the advantages that a real estate professional gets is that the losses that they take can offset their W-2 or business income. And so, where that really becomes key is through the tax savings of accelerated depreciation. At the start of this course, I said, this is real estate investing 101. Accelerated depreciation would be real estate investing 201 in my mind. It's kind of the next step up, and it's pretty complex. But I'll give you a brief overview of what accelerated depreciation is. What you would do is if, and it typically makes sense on higher value properties, is where it's the easiest or where it makes the most sense to go out and hire an engineer. Because a lot of times to do accelerated depreciation, you have to hire an engineer to come through the property and say, hey, now this house consists of a lot of things. It consists of windows. It consists of roof. It consists of flooring. It consists of kitchen cabinets. And the engineer is going to break it down and say, hey, of that 200,000, here's where each value is, because each one of those items actually in the eyes of the IRS depreciate over different times. So kitchen cabinets, I don't know what it is off the top of my head, but they may say kitchen cabinets depreciate over 7 years. And if the kitchen cabinets are worth 25,000, you can depreciate that over 7 years as opposed to the full 27 and a half. And I believe right now you can take up to 60% of the value through accelerated depreciation. That could change and go back up to 100%, but it allows you to basically take a massive loss whenever you buy a property. And if you're a real estate investor and you are a real estate agent and you had $100,000 of income as a real estate agent, but you go out and buy this property and you can appreciate it $50,000, that $50,000 comes off of your income and you'll only pay taxes on the $50,000. Again, I'm not a CPA. This is more of an advanced tax strategy around real estate investing, but it is something that is on the table. It's a little bit easier to pull off whenever you actually fully renovate a property because you're investing that into the property. And you don't, from my understanding, you don't need an engineer in that situation because you have receipts where I spent $8,000 on flooring throughout the entire house. I know that the value of the flooring in this house is $8,000, so I can go ahead and do that accelerated depreciation. That's a quick overview. If you want to learn more about that, I highly suggest talking to a CPA or give me a call. I could walk you through it a little bit more in depth as well. Now, I want to walk you through some terminology you need to be familiar with if you're going to do real estate investing. The first one is the 1% rule. If you've been around real estate or real estate investors, you've probably heard them talk about the 1% rule. And what the 1% rule states is essentially in this scenario, if you purchase a home for $200,000, how much should it rent for? 1% on a monthly basis. So that means if this home rents for $2,000 a month, this may be a deal that I might be interested. Obviously, you want it to rent for as much as possible. So if it's $3,000, it's like, oh, this is probably a deal. But the 1% rule gives you a quick glance as to, hey, is this worth me digging into? Because it takes time to properly analyze deals, and you don't want to waste your time on stuff that you know won't make sense. So, for example, if somebody says, hey, I'll sell you this house for $200,000, I have a tenant in it for $1,000 a month. Well, that's nowhere near the 1% rule. I can tell you that doesn't make sense without going in depth into it. Couple other terms that you'll want to have a better grasp of. I don't use these a lot personally, but I know a lot of real estate investors do. Net operating income, that's the annual rent on a basis, and you deduct all your expenses, but not include the mortgage payment. So in the example I covered earlier, where we had a house that we were renting out for $2,000 a month that had $24,000 of income and they had $6,000 of expenses, your net operating income and that would be $18,000. And cap rate is essentially you calculate that by dividing your NOI by the purchase price, and that'll give you a percent that is then your cap rate. The thing that I focus on more than anything else is your cash on cash return. And how you calculate that is your cash flow divided by your total cash invested into the deal. So if you buy a property for, let's just do the 250,000 like we were talking about earlier, $250,000, and you rent it out for $2,000 a month, your cash flow is not $2,000 a month. That's your net operating income. Your cash flow is your true profit at the end of the month after you pay all of your expenses and also take into consideration such things as vacancy, saving back for capital expenditures, saving back for expenses. We'll dive into that here in just a minute. But let's say out of that 24,000, your true net profit is 6,000, and you invested 20,000 into the property. Then how you would calculate that would be $6,000 of cash flow divided by your $20,000 cash investment, and that would give you your cash on cash return. So in that particular instance, it would be 30%, which you're not going to get a 30%. That would be amazing. I would buy that deal all day, every day. But again, how to calculate expenses. Mortgage, pretty self-explanatory. If you have the place mortgage calculator, you can go in there, put in how much you're paying for the property, what's your interest rate, how long you're going to amortize it over, and you'll be able to calculate what your mortgage payment's going to be on a monthly basis. Taxes, get with a good real estate agent. If you want to calculate it yourself, you can go to county records and it will show you how much the property taxes are. The one thing I want to warn you is if somebody's living in the house, they most likely have a homestead exemption. And if that's the case, your taxes are going to go up because you will lose that homestead exemption if you're not living in the property. So in that situation, if you go to Google, type in Indiana property tax calculator, I think it's the second link down. You can go in there and you can put in what county it's in, what township it's in, the assessed value from the county records, put down that it's going to be a rental property, and it will tell you what your property taxes will be. Again, this is kind of the shortened version of the class that I went over as a part of our wealth club. We actually did some examples and I walked them through like how to actually do all these tasks and how to run numbers. So I'm sorry, we're not getting the full experience, but this is better than obviously nothing at all. Insurance, check with an insurance agent, but once you do it a few times, you'll get a feel for it and you won't necessarily need to check with them every time. Maintenance, these are such things as, you get a roof leak, a light bulb, you have an issue with a light flickering, whatever the case may be. Just general maintenance on the property, typically it's going to be 5 to 15%. Yes, that's a huge range, but if you get an inspection on the property, you know the age of the property, you can get a feel for should I be on the higher end or lower end than that. On my deals, I typically put in 5 to 7%, and honestly, on most of my properties, they don't even hit that high. Capital expenditures, that's such things as major expenses that we know we're going to face at some point or another. We know the roof on the house goes bad. We know windows on the house will eventually rot or break or go bad. We know that the furnace and AC is eventually going to need to be replaced. So again, if the roof is newer, the HVAC is newer, you can go on the lower side at 5%. If all those items are about on their last leg, you can put down 15%, but if they're really old and on their last leg, you're not going to recoup 15% quick enough to pay for it all. So you definitely would want to have a nest egg set aside to address that. Next thing is vacancy. So whenever somebody moves out of a house, it obviously takes time for you to fix the house back up, maybe just clean it, advertise it, and get a new tenant in there. I, on average, plan on about 3 weeks to turn one of our properties. And so that's like right at about 5.8% is what I typically calculate for that. So that's going to vary depending on what price point your rental is at and what location it's at. So you could be higher or lower just depending on how desirable the property is. And then last but not least, property management. I always put 10% in there because what I found is a good property management company is probably going to charge you around 10%. And even if you're going to manage it yourself, I highly suggest you include that line item in there because if you're managing it yourself, you're essentially buying yourself a job. So you should be compensated for that. You don't want that to calculate into your cash flow and how good of an investment is because somebody has to do it and it's taking your time. So on the properties I manage myself, I still include that 10% management fee because I want to see what my money is earning as a passive investment, not as me actively managing a property. So I use biggerpockets.com. It's a great resource. I think they give you like you can analyze up to 5 or 10 deals for free. After that, there's an annual fee to use that. As I mentioned during our Wealth Club class, I actually pulled up Bigger Pockets. We did an example property and we ran through a scenario where an agent on the team was interested in like, hey, could this be a good fit? And we ultimately determined that it was not going to be a good investment for them. One of the things that people really struggle with though is how do you find investment deals? First thing is find a really good real estate agent. If you're not a really good real estate, if you're not an agent, find somebody that's really good that you can trust and can work with. Reach out to me. I can connect you with somebody as well. But on the market, that's the MLS. You can look at homes as they hit the market. Sometimes there's fresh rentals or maybe a property that needs work that could be an immediate investment. But whenever I'm buying real estate deals, I'm typically wanting to get a discount. I'm wanting to get some immediate equity in the property. So whenever I'm looking the MLS, I'm typically setting up some preset filters, meaning I'm looking at homes that have been on the market 90 days. They've had a price adjustment in the last 30 days. And then I'll go through and read some of those descriptions that says motivated seller will entertain any offer. These are great people to go in and make an offer on. You could also go through and find expired listings, meaning houses that didn't sell, and make lowball offers to the sellers direct in order to try to save some money there as well. And find yourself a better deal. So like if you're working, well, let's say you're working with me, I'm your real estate agent. We could pull through a list of expireds and I could present offers on your behalf to all these expireds that could maybe get you some instant equity. Another place you can look is wholesalers. These are people that are finding off-market deals that are then looking to sell them to investors and they make a spread on that. They're great people to contact if you're looking to buy real estate investments. Pre-foreclosures, people that are behind financially on their property that need a quick sell. These could be great people to reach out to for rent by owners, people that are currently trying to rent their home. You may call them up and they say, hey, I'm having trouble renting it out. I'm tired of being a landlord, and they may agree to actually sell the property to you. Facebook Marketplace is another place to look. And then last but not least, I wrote down is drive for dollars, meaning you're driving around looking for vacant houses that just need work. And then you're cold calling or mailing the owner of those properties, seeing if they're interested in selling them. So once you find your deal, you obviously need to buy the deal. And there's a few different options in regards to what you can do. Traditional financing, meaning you're not moving into the property and you're buying it strictly as an investment. You're probably looking at about 20 to 30% down with a local bank, a mortgage company, or you could do a DSCR loan. Now, if you're looking to move into it for 2 years before you turn it into a rental, you could get in with very little to maybe even no money down. Another option is the seller financing. So maybe you find an older landlord that's tired of dealing with the property, but they still want some monthly income. You could work out a way to make payments to that seller, and then you manage the property and you make some spread on the cash flow. And in these scenarios, you could get in it with literally no money down, or you can negotiate a very small down payment. You get to negotiate your interest rate. So there's a lot of different things you can play with. If somebody says that, let's say you're going to buy a rental property and the seller wants 200,000 and you're running numbers and you're like, this doesn't make sense if I go out and get a mortgage over 160,000. Okay, well, what if you do seller financing and the seller doesn't charge you any interest? Maybe you can give them the 200,000 spread out over time. So it helps to be creative in how you finance your deals as well. Hard money lenders is another option as well. These are people that are not traditional banks that are loaning you money for a short period of time. What you do is you use the Burr method at this point. You go out, you buy a property, you rehab it, you stabilize it, rent it out, and then you refinance it with a bank because you have a tenant in place, and then you pay off your hard money lender, and then you can repeat that in order to grow your portfolio. And then last but not least that I wrote down in here is you could partner with somebody. Maybe somebody's looking to invest in real estate, but they don't have the time to go out and find deals to manage their property or do the renovations. Or maybe you find somebody that's willing to do all that, but they can't find the deals. Partner with them. Say, hey, will you give me 10% ownership if I do this, or whatever you can structure with somebody that's willing to partner with the deal. So I know this was a very quick and abbreviated version. Whenever we did it in the wealth class, it took about an hour and 15 minutes to go through this in depth because we covered a lot of examples, went through bigger pockets, and did an in-depth analysis on some properties. But hopefully you found this valuable. If you have any questions, don't hesitate to reach out to me.